Hello, everybody, and welcome to the Crypto Hipster Podcast. This is your host, Jamil Hassan, the Crypto Hipster, where I interview founders, entrepreneurs, executives, thought leaders, amazing people all over the world of crypto and blockchain globally. And today I have another amazing guest. He is a co-founder. He's a co-founder at Saga. His name is Jin Kwon. Jin, welcome to the show.
Hello. Thanks for having me. Wonderful to be here and to be able to talk about, my experiences and share some stories with your audience.
Awesome. I'm looking forward to it. So let's kick things off. I ask you the first question I ask everybody is what is your background, and is it a logical background for what you're doing now?
Yeah, kind of. I mean, accidentally. I've had a pretty meandering career, I would say. So I was originally an engineer a while back when crypto didn't really exist. I was a computer architect. So I worked at Intel, did really random stuff around like silicon photonics, which is like trying to replace electrical channels on chip with optical channels. So I was doing a lot of research around that. So that was like a lot of like systems design, how to think about large components that communicate with one another. I was an engineer for not that long, like 6 months or so, and I quickly realized that I didn't want to kind of dive really deep into one small subject, which is kind of generally what happens when you're in engineering. You become an expert at like, the scroll bar on Facebook or something like that. And you're like, I didn't want to do that. And so I went to business school and I popped out on the other end as an investment banker. So I was doing investment banking for a few years, doing M&A advisory work essentially. So I was at Bank of America Merrill Lynch, and then I was at this firm called Centerview, which is like a boutique investment bank, for a little while. Around that time, I kind of started hearing things about crypto, especially because my brother founded a company called Tendermint at the time, which is the company that built Cosmos and shipped, the Cosmos Hub and things like that. And so he was like, "Hey, you should come and start exploring a little bit about this crypto stuff because it's going to start blowing up." And so back in 2018, I kind of folded my chapter of my life from investment banking, and then decided to join Tendermint and grow kind of Cosmos. And then I was there for about a few years. And then recently I guess not recently, about 3 years ago, I left and co-founded Saga essentially to start building what Saga is today. So
When were you at Centerview?
Centerview, I was there 2016 to 2018.
Okay.
Yeah.
All right. I was never there. I know people who were there.
Oh, is that right? Yeah. So I was in the technology office. So Centerview used to do technology investment banking out of New York, and then they moved and opened an office out in Palo Alto. And so I was like one of the I guess it's not a founding member, but like one of the early people who joined essentially and grew that office essentially out of Palo Alto. Yeah, it's a cool firm. It was an interesting experience. I got to deal with a lot of kind of massive technology companies, which is pretty exciting ultimately. So
Awesome. So now you're one of the co-founders of Saga. So I want to find out what Saga is all about, including your mission, your vision, how you see it playing in the future.
yeah, so Saga is at the fundamental level, it's a layer one to launch layer ones. And so Cosmos is, it's a kind of like a code base that allows people to use to build new chains. A lot of people kind of misunderstand Cosmos because they don't know that a lot of their most popular chains out there actually use Cosmos in the background. But people kind of think of it as, Atom or the various ecosystems. But there's, BNB chain, for example, is powered by Cosmos. There's back in the day, Terra was powered by Cosmos. Obviously, that was giant and imploded. But the thing about app chains ultimately is that it's very complicated for someone to try to build their own kind of layer one or an app chain essentially today. And what Saga is we're trying to simplify all this into almost like a AWS experience, where if you, as a college student, let's say I want to create a website, you can go to AWS, you pay like $10, and then you get like a website essentially, and you can kind of start getting your website started immediately. That doesn't really exist for infrastructure in crypto. And so the purpose of Saga from day one was, let's build an app chain that essentially you can create another chain within 10 minutes, essentially. And so that's has been our vision. Saga essentially allows you to go and do this permissionlessly without talking to any BD people, any kind of operations. You go on chain, you put a transaction in saying, hey, I want this chain with this configuration, and then the chain itself automatically in the background provisions that chain for you, and secures it, does everything that somebody would need for a chain, essentially.
Got it. So app chains. I think Polkadot is an app chain. So how do you differ from them?
Yeah, so Polkadot is interesting. I would say a lot of the times with these app chain models, the economics is what really differentiates ultimately. The flavor of app chain, what kind of technology it uses, really is not that important. The thing that's different about the way that Polkadot thinks about things is if you're familiar with like how Polkadot charges for their parachains, it's an auction essentially. So builders have to go and kind of bid on, let's say Polkadot has 100 slots, which is they can have 100 chains. Builders have to go and fight for that 1 in 100, which is kind of inherently the same economic model as every other chain out there. Because if you think about it, if you go on Ethereum today and you deploy an application, whether your users can use your application is determined by a competition amongst the people who want to use your applications to pay gas, essentially, right? And what Polkadot is they did that except for the number of chains, essentially, instead of the actual gas ultimately for end users. What Saga does very differently, and philosophically, it's very, very different, is that we think chain provisioning and infrastructure is a commodity business. And we do not think that having people pay more and more and competing for that is a business model that really makes sense in any scale or any use case, essentially. And so what we do is we flip that around, essentially. And what we say is, humans are very good at provisioning infrastructure and compute. We are excellent at building data centers out there and giving access to that for very cheap. And so what we should do is we should build the economics such that it's a commodity business. So what we try to do is drive prices as low as possible and flip the model such that when someone pays, let's say, $500 per month, they can get a chain, essentially. They don't have to, it's just $500 a month. It never changes. It essentially is a recurring fee. And as soon as you stop paying, you essentially lose that chain. You have to pay again later when you want to turn on that chain again, essentially. And so the economic model is very, very different between other kind of app chain models versus Saga ultimately.
Interesting. So commodity. That's a unique way to look at it, actually.
Yeah, because if you think about it, like this is kind of the same cycle that cloud kind of went through as well, right? Like back in the day, the people who were able to build interesting applications were the ones who could build data centers, right? So, in the early days of the internet, Netflix had to build their own data center because AWS didn't really exist as a service back then, right? So people who could build interesting internet applications were also the ones who had enough capital to build these like multi-million-dollar data centers ultimately. Today is a little bit different, right? So turns out at the time, a lot of companies thought that mainframes and building data centers was like was the way to go, and that was the future. And a lot of those companies failed because they failed to realize that compute and infrastructure is always tends towards commodity. It is just kind of how reality has always become. And so you have to design your infrastructure to think ahead in terms of how the business will evolve into, which is, block space and blockchain is also going to become a commodity business. And so you might as well design your system such that it can accommodate that, essentially.
You said mainframe. My first corporate job out of grad school, I ran a query on a mainframe at a manufacturing facility.
Mm-hmm.
And I ran it. I was running it from 1999 to 2000. I ran it from 1899 to 2000, and the whole entire plant was shut down for a week because the mainframe was running this query and they couldn't stop it.
Yeah. And building that mainframe cost somebody like millions of dollars, right? So it's like a little ridiculous to, if you think about it today, like as I said, you can just, even though there are some outages with like AWS and stuff like that, but it's so much easier to kind of provision something. And I think all of this really started with it wasn't even Amazon that like really started this. It was Heroku actually that started this whole journey. And so, ultimately it's like I don't think blockchains right now, at least this iteration of it is the economics does not make a lot of sense in my head. It's a short transition period in which eventually once real use cases come into blockchain, as mentioned, all of it will drive down to commodity. And you can kind of see that happening with layer twos and other places where infrastructure cost is pretty cheap, right? It's cheap only as long as there isn't demand for that block space. And so let's say like one day Visa's like, we're going to put everything on Ethereum. That's just not going to happen. Then everyone's going to pay $10,000 for every transaction. And so, you might as well just begin that journey already by assuming that this is going to become commodity, which then makes it easier to onboard mass scale applications essentially. So,
Got it. So let's talk about those economics. Want to find out what the current state of DeFi economics are is are, and traditional why traditional staking models to achieve yield are no longer working so well.
yeah. So, I mean, those are I would say two different questions. They're kind of related. I'll start with the staking part. I mean, the staking part is pretty simple, right? So, uh, a a economic model in which you're paying for people to stake, you need to be able to, as a protocol, generate an equivalent amount of, whether it's dollar or ETH or whatever. Let's just say like equivalent value as what you are emitting in order for the system to be to reach equilibrium, essentially, right? So there isn't like I think a lot of crypto projects in the past are used to the paradigm where there's demand for your token value, uh, regardless of if you really generate value or not. That is constantly going to shift because there is a kind of cascading situation where people get burned from protocol saying they're going to eventually create value but they don't create value, right? So this cycle started with a lot of implosions back in like 2021, and then if you take a look at this cycle, essentially it's pretty similar where there's like meme coin cycle kind of started. People realized, okay, this is not really sustainable, so they leave that. They went to perps kind of imploded as well, and so there's this like cascading effect that there isn't going to be in the long run infinite supply of people who want to buy into your tokens just by existing, essentially. And so staking is, it's just an emission, right? It's pretty simple to do. I'm not saying tokens are stocks, but if you kind of conceptually think about it, if you had a company that wasn't generating any revenue, but was issuing new stock that's doubling every few years, you can imagine what the stock price will do, right? Eventually, the fever for people who want to buy that stock will disappear, and then it's going to plummet, right? And so this is just, crypto kind of running into the same situation ultimately. And so going back now to your first question, which is like, what is the state of DeFi? It's like, this is why, if you take a look at specific applications out today, the ones that are doing well is the ones that are able to generate revenue essentially and funnel that back into a token value. And so the equation is pretty simple. It's like you have staking rewards. It's like your protocol just needs to generate more yield than you're emitting essentially. And once you have that equation, then the model will work again. It's just it's harder to find ways to actually generate revenue, right? Than hype ultimately. So.
So let's take an example of one that happened, something that happened recently. I'm sure you saw this. Cadena said we're shutting down the chain. The blockchain, of course, will still exist. But what if I mean, people think that Cadena, was involved in the perps, and they blew up as part of the industry. Blew up a couple of weeks ago, and there could be others we don't know about yet, right? What if the management of these teams do not manage properly, but the chaining still exists? Is there a way other people can say, hey, we think we can do a better job than they did, and then come in and then start managing that chain? What prevents them from doing that?
Yeah, it depends. It's really case by case. This has happened a lot before, right? Where if you kind of think about it, the OG Bitcoin kind of ran into the same situation, right? There was a founder. That founder is no longer there, or we don't know who it is, but the team that took the banner and moved with it is a completely different group of people than the people who originally started it, right? So, um, it's possible, but a lot of the times, everything in the crypto ecosystem is kind of like a scale of how it begins and how it transitions essentially. Most crypto projects out there begin fairly centralized with an entity that needs to manage it and maintain it, right? Eventually down the line, it comes to a point where it's decentralized enough where there's a community of folks who will maintain it afterwards. But that middle point is a little tricky. It depends on how the project planned out the community, and a lot of the times, as far as I can see, the projects these days focus more on not transitioning later and later, essentially, to this model because I think back in the day, I would say like in 2020, there was like a how do I say this? A definite preference for having decentralization as a center tenant of a project was highly valued, whereas now it feels very different to me, which I find a little bit disappointing. But you know, I'm not the market. I'm not going to dictate how the market should react. So, it ultimately it's a lot of this has kind of come from, I would say, the move away from layer ones into these kind of roll-ups that really are much more centralized. And so, all of this I think is related to one another, where over time, people have started kind of building organizations a little bit more centralized because their infrastructure is also slightly more centralized. So it's like there's this like cascading effect that happens where everyone kind of rushes towards this more centralized approach. I mean, I think it's gonna pivot back into the other direction eventually, but it's just not the reality at the moment, essentially. So
So let's talk about that approach, right? I believe at Saga, you propose a better, sustainable approach for real usage and liquidity flow, right? What's that like, and how do the mechanics of your approach work?
yeah, so in the generally speaking, what most folks try to do is build walled gardens because that's the most efficient way of building a moat. And that walled garden is generally TVL. It's like what every crypto project tries to keep like within their little walled garden at all times. We try to we're trying to rip that apart a little bit because TVL as a metric on your chain does not really matter as a kind of like for any end user or any kind of metric. It's mostly a vanity metric. It doesn't really matter. It's like subscriber count. Like who the hell cares, right? What you want to do is that flow that I just described, which is how much are you paying for infrastructure? How much are you earning in terms of revenue? That net difference is what matters ultimately. And TVL as a metric does allow you to generate more revenue on your model only if you use it properly, essentially. So what we're doing is we're building a model in which we're like flipping all this upside down. So um, to begin with, let me try to describe. It's a little bit complex, and so the way that we are building our DeFi ecosystem is the TVL that's inside of Saga. Essentially, we want to redeploy that TVL somewhere else and earn yield on it, essentially outside of the Saga ecosystem. And so, from our perspective, this technically does increase the TVL of everyone around us, but we don't care about that because what we're trying to do is import the yield opportunities from outside of Saga into Saga. And so let's say, for example, the best place to yield farm, let's say, is Ethereum mainnet. Why would you not want to tap into that ecosystem and import that yield opportunity into your ecosystem? I don't know why other folks are not really thinking too much about this, This is the model in which we have a way of doing it. And so we have a protocol called Colt coming out, essentially, which is what's called a reserve protocol. So when someone brings in a stable coin from outside of the ecosystem into our ecosystem, it first goes through this protocol called Colt, essentially. And let's say, for example, you have USDC. You want to bring USDC into Saga to do something, anything you want. You're not going to be able to use that USDC directly on Saga. What we have is Colt essentially holds that USDC, and then it will issue a stable coin called D, essentially. You can use D within the Saga ecosystem and do whatever you want with it, essentially. In the background, what Colt does is that USDC you brought in, we will convert that into a yield-bearing equivalent in the background, essentially. So it will no longer hold USDC. It will hold, in certain scenarios, we partnered with YieldFi. So there's this stable coin called YUSD, which is a yield-bearing version of USDC, essentially. And the protocol itself essentially earns on the capital basis of all assets that has flowed into the system, essentially. And so we've disconnected now the asset that's trading and creating activity in Saga, and we are using that as a way to essentially build and bring in yield from outside of the ecosystem in, which grows the value of the entire ecosystem. And so from our perspective, that this is like kind of like the model. We import the best yield from outside of the ecosystem in, we import the best assets that can be used that. And then what Saga will be is the meeting point in between the two that allows people to do really interesting things with assets to earn the yield, essentially. And that's how we're thinking about our ecosystem for DeFi.
Okay, so let me see if I got this right. Your yield is going to be pegged to a floating basket of what investments come into the system instead of like another stable coin or like a US Treasury risk-free rate. It would be like from whatever combination of investments that come into your platform.
Yeah, or whatever combinations of like yield opportunities outside. So like what Colt does is, let's say Colt has like $10 million of USDC as reserve, essentially, that various users have brought in. It will convert that reserve. It will look in the entire crypto ecosystem and be like, okay, maybe Berachain has the best yield right now. So what we're gonna do is we're gonna figure out a way to get our US dollars and earn yield on Berachain, for example. When you do that, what ends up happening is what generally speaking protocols do is everyone just tries to out incentivize each other. So let's say Berachain is spraying their staking tokens to try to like incentivize TVL because they're trying to create that moat. They're like, we want people to come in with their dollars and stay in here, right? What we can do is we can try to compete against that, which then would be like everyone is just trying to outpay each other, which is like kind of the model that everyone is going towards. Or we just sit here and go, wait a second, why are we doing this? We're just gonna kind of take that yield and we're gonna bring it in here, essentially. And that's the model that we instead decided to do. And so what Colt will do is over time constantly look at the best yield opportunities out in the world and essentially yield farm on behalf of the user, essentially, and find the best places. So the user just has to take that D and deploy on Saga, and you will earn the best yield because Colt itself is constantly moving assets to the best places to earn yield ultimately. So we get to import the best yield, and the user never has to go and like research this. They don't have to go out and change assets every 3 months because the best yield opportunity is somewhere else. Colt essentially automatically does that. And then all the yield that Colt earns, all we're doing is we're shoving it back into Saga and incentivizing behavior. And so now all people have to do is they will always earn the best yield just by having deployed in Saga, essentially. That makes sense.
It makes sense. Makes sense. My team and I, AIG, built something similar where the risk and then the investment managers could pick the yield they wanted, based on the instruments and stuff. So I know it's a lot of development work you did.
Yeah. I mean, it's like it's one of those things where DeFi and crypto moves very quickly. It's a lot faster than most ecosystems. And so where the best yield is like something that is not very obvious to a lot of users. And you have to constantly research and you have to keep moving assets back and forth constantly. And so from our perspective, we're like, wait, why don't we just build essentially a system that just does that for you? you just deploy once in Saga, and Saga, the protocol itself will go and hunt out the best places and the safest places to earn yield, and the users don't have to worry about it. And that's the model that we've essentially developed with that we're launching, I think, next week. So that's quite exciting in my opinion.
All right. I think it's pretty cool. Now, I might have one concern, and I want to see how you're different here. We ran into some problems back in 2022 where some managers, like Celsius, I was a Celsius customer, where they would rehypothecate people's investments, right? And they lost on the yield farming and they had to go bankrupt. So what's the risk there? What's the difference between you and that situation? And what risks are people taking on for themselves, or are you fully taking on the whole risk for the clients?
Yeah. So the difference is Celsius was, and this is the problem. This is why crypto is amazing. Is when you gave money to Celsius, you had no idea what the fuck was going on. Oh, sorry. I don't know if language is a problem, but
Good.
you have no idea what's going on, right? So here, everything is on chain. Everything is monitorable. So when, let's say, I mentioned you're going to bring in USDC to, let's say, yield farm on Saga and convert to D. That USDC you can see is in a wallet. When that redeployment of assets happen, that conversion into a yield-bearing equivalent happens on Colt, that yield-bearing token is sitting in Colt, essentially. You can see it, it's verifiable, it's always there. And the way that you think about it is Colt has to be careful, obviously, of which assets to bring into, because if the underlying asset collateral is unsafe, then Colt also becomes unsafe, right? So you just have to make sure that whenever you convert into assets, the assets are always transparently trackable, essentially. And as long as all the pieces downstream is fully trackable to everything that's going on, there's very little risk, essentially. And so, but this is like really what crypto is about. It's like opening up all this, right? Yeah, if we wanted to build like a closed box system, we could have just done what it's a lot easier to do so. But this is a fully on-chain verifiable solution, essentially, that's a little bit different than the previous iterations of this, essentially. So
I'm looking forward to see how it works. Yeah. So you said the word uncertainty, right? And we're talking about the future of DeFi. And I don't know if you saw the news yesterday. I think everybody saw the news yesterday, including people in crypto and not in crypto, that CZ was pardoned by Donald Trump. And whether or not people agree with that or not, that creates uncertainty, in today's global economy, not just crypto economy, but the total global economy. So what do you think the future of DeFi is, and how we're gonna navigate this uncertainty at this point now?
I would actually argue that things became a little less uncertain, because if you think about it, the arrest of CZ and is really what started a lot of uncertainty, especially in the US, right? So like for US builders, at least, it was like, because the regulations in the past were not very clear, you have no idea what kind of landmines you're walking into if you're a US-based founder, essentially, in crypto, right? With the arrest of CZ, it was like compounded. You're like, oh, like an exchange like Binance touches everything. So it's like, if you accidentally trigger something while operating Binance US, it's like that's gonna be the same situation in DeFi. And so now with, at least in my opinion, like with the recent kind of trying to make the regulations a little bit more defined, and also with this pardon, essentially, it kind of signals that we're moving towards a point where things are a little less uncertain, at least for builders for the US. Rest of the world, kind of the same. But I ultimately think this is a good thing. It's regulations is something that it takes time for it to catch up, and DeFi is always kind of on the cutting edge, and so we're always kind of in a space where it's a little bit uncertain, and you have to be okay with embracing a little bit of that. So
I didn't look at it from a builder perspective. I was looking at it only from an investor perspective, and mainly from people who like 1000x, and
yeah. But
that's not me.
I think if you think about it, though, like there's not a lot of risk for users or investors here. Like not in terms of dollar value. I meant like regulatory risk. It was always builders that was in my opinion the biggest problems. Biggest like landmines were like, if you think about it, like who are the people who are arrested? Is Tornado Cash developers? Is Binance who are building tools? Right? Like it's that. And so I think that is the biggest thing that the US kind of needs to solve is this uncertainty around builders. And once the builders are able to come in, then users are is a little bit, it will flow in and make it a lot easier essentially for end users.
So a lot of builders over the years have left and gone to Dubai and other places. So you think
Yeah.
this will give them an opportunity to come back, well, if they want to the U.S.
Yeah. I mean, I'm a US based builder. I've always been US based, and I think the direction of embracing decentralized finance and crypto in general, and making that part of a nation strategy, I think is a good idea because that's where it's going to happen regardless if you embrace it or not, in my opinion. So
Got it. That makes sense. Well, that's great news. So um, I want to thank you, very much for your time today. It's been a wonderful conversation. I enjoyed it, and I have one last question for you. It's how can people find out more information about you, about Saga? How can they begin to use your platform, once you're live and get the best yield? How can they do that?
yeah. The best place to come would be like every other crypto project is, our Twitter or X essentially. We'll put a lot of information on there. I think the protocols that are coming live, they have kind of profiles as there. We're going to retweet all their stuff, but the builders essentially will have guides. They will have places to go, Discords for help, and so just reach out. Our team is pretty friendly in general, and so if you want to go and learn a little bit more, you can always go to Saga.xyz is our website that has information, but really DeFi and yield farming and having conversations, it's best to do it in a more of a social platform. So join our X, follow our X, join our Discord. There's a pretty good community there. So
Awesome. Thank you very much for your time today.
wonderful. Thanks, man.